You are not going to predict the next market crash. At least that's what they're saying in this video that we're going to watch today. And you've probably seen all the videos out there talking about how AI is in a bubble, AI is going to be the next market crash, blah, blah, blah. I'll show you exactly the 3-step test that I'm looking for that has predicted every single market crash ever in the history of time. Maybe he'll even talk about it in this video. So we'll do that together. I'm just going to make your life so much easier, right? You follow these 3 simple moving averages, the outlier trend template, you're going to know everything you need to know. So let's watch this video together. You're not going to predict the next market crash.
At the minute, doesn't it feel like absolutely everyone is saying there's going to be a crash soon?
We will have a crash.
Crash could drag down the global economy.
These predictions get a lot of attention because, let's just admit it, right? We love it. We love predictions. Whether it's a groundhog or an octopus predicting a sporting event, to ancient soothsayers or oracles predicting the outcomes of wars or the weather. Or there's today, where we don't pin our hopes for a bountiful harvest on the backs of gods, we place the performance of our portfolios in the palms of people peddling predictions at a prodigious scale.
Okay, that's a great point. That is this whole channel's MO, is making stock predictions. And what's great about that, and what's great about actual fund managers, is that we don't need to make predictions. We don't need to make predictions. We can look at the data that we have. We can assess if we're moving with the trend or against the trend. We can assess, thanks to outlier, the fear and greed, the outlier 9. If the market's moving for you, the sector's moving for you, the stock is moving for you. You can put all this together, and you can make an assumption based on the data in front of you. But you don't have to predict anything. You can say, I will take a calculated risk. If it works out, awesome. If it doesn't, I don't have any expectations on the trade. And if it doesn't work out, that's okay. I'll just cut my losses and move on. That's the difference between a charlatan and a professional fund manager. We have the data at our fingertips. All we have to do is take an educated guess. And if it works out, awesome, let's run it. If it doesn't, that's awesome too. No expectations, we'll move on. So let's keep going.
Today, I just want to stop and ask what I think is a sensible question. Are any of these predictions actually worth listening to?
No.
In an AI bubble. Of course.
The most comprehensive study I could find tracked 6,582 forecasts by 68 different market experts between 2005 and 2012. They weren't amateurs, they were professionals with significant followings. 41 of these 68 gurus scored below 50%. The average score was 46.9%. So a coin toss beat most of these experts.
I will say a little bit of take a grain of salt with this, because I mean, you could be like, for example, we're in plan ETF right now, absolutely making a killing in plan ETF right now. But at some point, I'm going to take my exit signal and get out of the way. I don't know what duration we're measuring these things at, right? Because my duration may be significantly different than what he's measuring right here. Because if he's saying, over, a 18-month, 2-year, 18-day, who knows what sort of time horizon, accuracy at 46%, right? Well, what if I only hold this for 5 days? I'm not making a prediction for the next 5 years. And I think that's the difference between like an actual trader, an actual fund manager versus somebody who's just trying to get YouTube clicks is, oh, this stock's going to $500. I'm going to make a prediction. It's going to go there, versus the trend's working for me. I got my entry signal. I'll just wait for my exit signal. 6, 7, right? Following the plan versus making a prediction. It's on the surface, it can sound like they're the same, but in reality, they're not. Right? I'm not predicting that this trade will do anything. All I'm saying is I got an entry signal. I will wait till I get an exit signal. In the meantime, I don't do anything.
The best overall was David Nasser at 68.2%. Sounds respectable, right? But after the transaction costs required to keep up with the tips that these guys were giving you, the study found that none of them would have made you any money. What's mad to me, right, is I can only really find one study on this. Maybe there's others that exist, they're just not as prominent, I don't know. But you would think in a world where the rewards of identifying people who were good at making these predictions, they're really high, right? If you can find someone who can make accurate predictions, you can make billions off those predictions. You think we would keep score of these market mystic megs more closely, right? Why doesn't CNBC show a percentage next to their talking heads every time they're on TV of how good their predictions are? Probably because if they did, it would become very clear very quickly that their track records are patchy at best.
Funny story. So I've been on TV probably 200 times. And the very first time that I was going on TV, I remember I was just like sweating bullets. My palms were so sweaty. And I was talking to my publicist at the time, which ended up being a horrible person. I couldn't stand her. But at the time, she was like, Chris, don't worry about it. It's okay. Just, give your opinion. And if you're right, no one's going to remember. If you're wrong, no one's going to remember. And I was like, I'm paying you how much money to be on TV, and you're telling me no one's going to remember what I have to say? Totally worth this. What a waste of time that was. But it's true, right? So like Jim Cramer, people point to him all the time and saying like he's like the inverse Cramer, right? Whatever Cramer says, do the opposite. And I say this all the time as well. It's whatever I say on YouTube, it's gonna be the opposite, right? If I tell you a stock's gonna go up, it's gonna go down. If I tell you it's time to sell, it's gonna go up. I'm telling you, it always works that way because that's how people are designed, right? They are looking to find those flaws rather than saying, you know what, this guy has a plan, this guy is following the plan. The outcome will be what the outcome will be, right? Chris made me sell my DeFi shares. I don't make you do anything. I'm just looking at it objectively as a professional fund manager, which I would encourage you to do the same as well.
But looking at this list, while these guys might be prominent in the industry, they're not exactly household names, are they? So let's broaden this, shall we, by looking at some big guns. I've got some tarot cards here that I'm going to use in this for dramatic effect. I love a theme and all that, and it's kind of in keeping with our whole prediction thing, isn't it? Funny thing, I ordered these off Amazon, and I forgot to put my name on it. So for some reason, it pre-populated my missus's name. And she was genuinely convinced when these turned up and she just opened this random envelope addressed to her with tarot cards in that someone was trying to place a curse on her. Wait till she gets the Ouija board. Today, we're going to start here. Michael Burry is a star investor.
I'm gonna have to like censor that right in the middle. Oh no, this is a family channel.
Because he famously predicted the 2008 financial crisis. He became a household name due to Christian Bale's portrayal of him in The Big Short. Just go onto YouTube, type Michael Burry, and you have countless videos analysing what he's up to and the predictions that he's making. The fact that people use Christian Bale's image in the thumbnails and not Michael's actual photo kind of shows how ridiculous this all is. It speaks to a wider issue you have when it comes to listening to predictions. You can find lots of claims that since 2008, Michael has predicted a...
Exactly. Right. And that's kind of what my publicist was saying. It's like, you can say whatever you want. Nobody's going to remember. But if you get it right once, you can always hang your hat on that. Next on CNBC, next on Yahoo Finance, next on whatever, we've got the man who predicted the crash in 2008. You can always hang your hat on that. Always hang your hat on that.
Crash every single year, and that he's always been proven wrong.
Oh, Peter Schiff too. By the way, my publicist was also Peter Schiff's publicist. That was the whole thing as well.
But there's potential for prediction misinformation here. A challenge for people following his predictions is working out whether he actually said there would be a crash every year, or whether Burry's Big Short reputation is being twisted for a sensational headline. Burry says that he's worried about index funds. That becomes him predicting a passive investment bubble. How many people then read this headline and panic? On X, Burry fashions himself by the name Cassandra, the Trojan princess who was cursed by Apollo to have her true prophecies ignored. So clearly this is a man who thinks that he should be listened to. But in 2023, he apologized through gritted teeth to the investing community, saying he was wrong to tell them to sell. I actually think the problem...
Predict a crash once a month, every month, and then you'll eventually be right. Yeah, exactly. And honestly, I think that's what a lot of people do. They go on TV, they make these predictions that nobody's going to remember. But when they are right, they will hang that as if this is the guy who correctly predicted this on September. You know, although he said the same thing in January, February, March, April, May, June, July, and August, he got it right in September. Shut up.
Problem here is that the finance world and investing community spends way too much time talking about what Burry says and does, based on a mythology not established by the Greeks, but by a pretty good movie. Okay, next we have the Emperor. Jamie Dimon is arguably the most powerful man in world finance. As CEO of JP Morgan Chase, he is the ultimate insider. He has the finance world in the palm of his hand. Yet there is a meme about Jamie that he has predicted 22 of the last 3 crashes.
Yep, there you go. Exactly. That's funny. That's exactly what we're talking about. right? Why make these predictions in the first place? I don't see the need to do that, right? Especially when you've elevated yourself to the point. In fact, hang on, I have a slide for this. I would think I was about to quote the slide. Hold on. Wait for it. Incredible content right here. Wait for it. Professional YouTuber at work. Wait for it. There we go. Those who ask me where the market will be in a year or at what level the S&P 500 will bottom totally misunderstand what it takes to be a great trader. I'm in the business of responding, not prediction. Telling the future is impossible and unnecessary. Trading is a now business. Now, looking back at this slide, right, I remember when I first started trading, 2009. I remember specifically, and thinking to myself, if I were to trade, I have to know which direction it's going to go. I have to, right? And you probably feel that same way too. If I'm going to put risk in the market, I need to know exactly where the market's going to go. And the truth is that you don't. And that's what Mark's trying to say here, is that you don't have to, quote, know where it is or isn't going. But you can make the best educated guess you can possible, right? And that's why we look at the market from top-down analysis. We look at the market. Where is the market going? Is the market bullish? Okay, cool. I'm not going to take short positions. What about the sectors? Are the sectors bullish? If the tech sector is bullish and the market's bullish, that could be a great sector to be in. And then you go into the bottom of the sector and you can find all the stocks that are bullish within that sector. And you can have incredible wealth generating activities just from following a top-down approach like that. Now, I wasn't the first one to come up with this. Mark wasn't the first one to come up with this. All the way back in the 1950s, this book right here, How I Made $2 Million in the Stock Market in the 1950s, Nicholas Darvis, who was a dancer, like literally a dancer, he would go around on stage shaking his booty and he would get paid to dance, was traveling the entire world, and he would do exactly this. He would find when the market was bullish, he would find when the sectors were bullish, he would buy every stock in that sector, and then he would hold the stocks in that sector that are working, and once that stock stopped working, he would just drop it out of his portfolio. So let's say he'd buy 10 stocks at a time, 7 of them kept working, so he'd hold those 7, 3 of those kept working, so he'd hold those 3, 1 of those kept working, so he'd hold that 1, and he would make amazing wealth from doing that. And at no point in time was he trying to predict the future. He was just looking at the sector, which sector is working now, which sector is performing now, which stocks are performing now, and then buy those stocks. And if they don't work, it's okay. Losing the expectation is the most important thing that you could do. Well, I always say this, I say that constantly, right? This is the most important thing you can do. One of the most important things you can do is not have an expectation on the trade, right? Do you think Nicholas Darvis was upset when 3 of the 10 that he bought didn't work out? No, because his 7 were paying so much more than the 3 that didn't work out. And then when he got down to 3 of the 10, do you think he was upset? No, of course not, because he was making generational wealth on those 3, and those other 7 didn't matter anymore.
Here's a list of some of his calls on screen. His latest is a prediction for 2026, so maybe that one lands. Okay, next up is my favorite. Jim Cramer is a former hedge fund manager, but today he's known for his long-running CNBC show. And this man rattles out predictions at an industrial scale.
So I went and bought more. I went and bought more right there. Well, could I have been more wrong? I don't think so.
In 2021 alone, he made 725 buy and sell recommendations to his viewers. There is varying levels of analysis on his performance and how good that these recommendations are. But when he's firing out buy and sell recommendations at a rate of 1 every couple of hours, how can anyone keep up with all the analysis required to manage all of that? But that's the thing about Jim. He's no longer in the business of generating returns. He's in the show business. Jim is the stock market jester, paid to perform to make predictions for his audience. And that's an important point, really. We need to question, why are these guys doing this? What?
Exactly. You're pulling up in YouTube and you're seeing all these people who are trying to tell you, buy this stock, buy that stock, right? Let's go to portfolios here, right? Let's see. Deep value stock. Cover calls explained. Let's see. And obviously not perfect examples, but this is live, right? Point being is that what is their end goal? Their end goal is to get clicks. Their end goal is to get sales. Their end goal is to, of course, sell their course, sell their memberships, whatever. And so is mine. I'll be outright honest with you. I make this content because first, I love the game, and second, I want you to be an outlier. I want you to be an outlier because being an outlier is probably the greatest financial decision you'll ever make the rest of your life, right? In fact, if you feel that way, put it in the chat, right? Don't take it from me. Put it in the chat. Because what we do here is different than everybody else. We're not making predictions, right? We're not trying to uncover this one stock that'll turn out to be the next NVIDIA. This one stock, $5 in here, and you'll be a millionaire by the end of the year. No, we're just looking at the data objectively. And for 82 cents a day, which is practically nothing, you can have access to world-class support. You're going to have access into the Discord. You can follow all of my trades where we're going to win the US Investing Championship. You have access to the full platform that has all the analysis broken down for you. In fact, this is one of the easiest ways I've ever come across with analysis. Let me show you this. By the way, Chris P says, best decision financially I've made in a long time. Let's see. Being an outlier pays money. Exactly. You're not paying money. You're getting paid money. Right up here, up in the corner. The Outlier 9 all at once is so handy. And you can put in, any of the stocks that we cover, so like Palantir, right? It'll show you if the market is set up, it'll show you if the sector is set up, and it'll show you if the stock is set up. And if all 9 are set up, that is by far the easiest, fastest way to know if this stock has a lot of potential behind it. Does that mean that it's going to be the next $1 million stock? No. Could it be? Yes, but nobody's making that prediction. All we're doing is looking at the data and we're saying, this is the most likely direction that it could head, right? Gas Trader says he's up 80% since April. Attila says the value of Outlier's ecosystem is super cheap for the value it provides. Skinny Buff Guy says, Chris made me be an outlier, right? And it takes the mental strain away. It takes the mental strain away, exactly, because you can literally pop up in here, look at your stock and say, okay, is it set up? No, I'm off. Don't worry about it. I don't have to do this anymore. And we're not predicting anything.
Are the incentives of the media and these predictors to make all of these claims all of the time? CNBC is on 24 hours a day. TV channels want people to say things because it gives them something to fill the time with. So what about the predictors? Isn't it weird that a man in charge of a bank who has an active interest in getting people to invest their money with them is constantly so negative about the outlook for investors?
And you're not worried about a recession in 2026 for the US. You made that clear.
I think it could happen in 2026.
He's a smart guy, right? I mean, he is no fool. So what are his motivations? If we're honest with ourselves, it's probably not to help you all the time. They're most likely these predictors trying to help themselves by either attracting clients, talking up or down their own investment book so that they can make money, or maybe just because they like to hear the sound of their own voice. Predictors predict not out of the goodness of their own heart because it directly benefits them.
This reminds me of, I shared this story about a week ago. A friend of mine texted me and he was upset because his financial advisor told him to just be content with 6% returns. Like, hey man, you're getting 6% returns. That's pretty awesome. And I was like, bro, I made 6% yesterday on my entire portfolio. And he's like, I knew this was a setup here. I knew I was getting bamboozled, was his words. And those predictions from like Jamie Dimon and stuff, right? He has a financial interest to get you to be scared so that you will invest with their advisors so they can then earn off of your money, right? If you deposit with them, they can go out and make loans with your funds. This is how the banking system works. Anytime you put deposits in a financial institution, they go make loans with it, they go make investments with it, right? And then they will pay you 6%, okay? They're out there making 16%. They're going to pay you 6%. They get to keep that spread, okay? Now, if you put it in a money market or a savings account and they give you 5 basis points, that's 0.05%. They're out there making 16%. They get to keep a huge spread. 16% super high. I understand that. But if you're looking at a financial advisor, which in theory, the wealth management aspect of these places, and they tell you, hey, 6% is great. Dude, they're sticking it in the S&P 500. They are getting the 10% a year annually. They're going to keep that 4% and then tell you made 6%. That is their goal. So if Jamie Dimon goes out there and scares you into saying you are not smart enough, because that's what they want to do. They want to convince you are not smart enough to trade in the market. It is a rigged game, only if you play by their rules, right? This is normal. This is normal. to be scared and say, I don't know enough about the stock market. I'm too scared to do anything with my money. I need to make sure that the super wealthy, the very sophisticated people like Jamie Dimon take care of my money for me. And then therefore you get normal returns. But you don't have to have normal returns. You can have outlier returns. Now, it does take some time, right? It does take a little bit of analysis here, but you also don't have to pore over hundreds of financial statements. You don't have to listen to earnings calls. You don't have to look at financial reports. No, you can just look at what the price is doing, look at what the data is showing, and then you can make a decision that more than likely, and I can't guarantee anything, could have a much higher expectancy than anything that you could get from a financial advisor. Chris made me sell my losing habits. There you go. Chris Martin says, I can't wait to become a full-time outlier. It's coming. I can feel it. I can feel it too. I can feel it for you. And yeah, Vincent right here. Banks try to scare you into investing a larger sum of money. My small account I made with them as a tester is still trashed. And now I made them self-accounts, outlier, and I've turned them around. Yeah, they honestly do want you scared. Because fear and greed are the biggest motivators in all of finance, right? If you're scared to invest your money, don't worry. Give it to me. I'll invest it for you.
There also is, or what appears to be, an asymmetrical risk to them. These predictors can become wildly famous for a single prediction, yet remain pretty unpunished for a series of bad calls. So they might as well make loads of predictions then. Now, not everybody has a patchy track record, of course. There are a handful of people whose predictions have been spot on.
By the way, so this is Jim Simons. Man, I'm pulling all the books off my bookshelf today. Jim Simons here. So I got to meet the guy who wrote this book, Greg Zuckerman. He works at the Wall Street Journal, and I love this book. This is number 6 of my top 6 trading books. Jim Simons is at Renaissance Technology. I think he passed away not too long ago. Either way, Jim Simons at Renaissance Technology had, I believe it was 60-ish% returns per year, every year for dozens of years. And when you have returns like that, you have masters of the universe money, right? Now, here's the cool thing. What we're doing here at Outlier, I would bet you, and in fact, I can really see this coming, is that they're going to be rewriting the book, The Man Who Solved the Market, to the Outliers Who Solved the Market. Because I'm telling you, we are changing the world with what we're doing.
Best example I can think of is probably Jim Simons. He created a fund that between 1988 and 2018 delivered a return of 2,103,217%. The S&P 500 over the same time period returned 914%. This man made 100% in the dot-com bubble, 83% in the financial crisis. He was famously private. He did not discuss the workings of his own fund. For all intents and purposes, he was a hermit. Now, you could use Jim or a couple of others as an example to disprove my broad belief that people can't figure out the market. But people like Simons are exceptions. They are not the rule. So the chances of you being him are slim. I mean, if you are Jim, crack on, go and do what Jim did.
I did a lot of math. I made a lot of money, and I gave almost all of it away.
He invented a money-making machine, then locked that thing away and let it run. I think we should be highly skeptical of anyone who says they know what is going to happen in the stock market and then gives that.
Totally agree. Anybody who says they know what's going to happen in the stock market is a charlatan.
Information away, which is worth hundreds of billions of dollars for free. If you're a business owner trying to make your own money-making machine and you don't want it to cost you hundreds of billions of dollars, well,
oh no, it's an ad. It's an ad read. YouTube Premium is so cool because it has this jump ahead button, so I can jump past this ad read. How do you like that?
Or just use the QR code that's on screen. Okay, I do want to take a step back for a second, and I want to say, at the minute, with the stock market, with the general global economy, there are clearly concerns. Lots of concerns. I mean, we could just point to the sustainability of the whole AI bit. I don't think that these people are just chatting crap, but I do doubt the ability of lots of people, all of these different predictors, to predict the direction of the market in the short to medium term. And I also doubt how useful it is for individual investors like ourselves to act upon all the predictions that we hear. All of the individuals that I've just covered there are highly intelligent, and their predictions that they present are often compelling, backed up by data, driven by intense research, yet they were still wrong. The problem we have sat at home watching these pundits is, how do we know who is going to be the person who is right? How do we decipher between, a good predictor and a bad predictor, because even having a track record of a previous prediction that went right is no guarantee that your future ones will be correct. If anything, it's the opposite. Also, as well, how do we know that the pundit is sat there based on their merit and not just because they got lucky? Nazim Nicholas Taleb produced a simulation in his book Fooled by Randomness, where basically he created 10,000 fake investment managers, each with a 50% chance of making money or losing money in a single year. Essentially, he was flipping a coin to simulate market performance. After 5 years, purely by chance, 313 managers had made money every single year. If I was to hold those managers up and go, look, these guys figured it out, these are the guys with the market insight, that's really just like me saying that someone who's won the lottery is gifted at picking numbers. Warren Buffett is probably an investment genius, but he could also just be the one example we have of a simulation running all of its combinations. He also just so happens to be an example of someone who's built his success not by making market or short-term economic predictions. In environments where there are high amounts of randomness, like the stock market, and there are large sample sizes like all of the investors that participate in the stock market, there will inevitably appear to be successful people due to purely statistical variation or luck. I think the only person who can really claim to have complete power over the market right now is Donald Trump and his inner circle.
Well, that's the truth. That's the truth.
And yet again, he keeps his antics surprise to everyone apart from those who profit from his social media posts. I know it's tempting to believe that people who work in finance, who speak with conviction about all manner of topics, are somehow in the know. I mean, it's literally embedded in what makes us human. Apophenia is the tendency to see meaningful patterns and connections in unrelated things. Is that cloud in the shape of a dog? Is that Jesus on your toast? Does that line on the chart mean the stock market's about to go up? This was a survival trait, because think about it. The person who could spot the tiger in the grass would survive. I know that that's a lion and not a...
All right, so let me teach you how to spot the tiger in the grass. Y'all ready for this? So what I want to do is show you every single market crash, largest declines in US stock market history. Now, it sounds like Damien is not aware of the outlier trend template, but you will be in just a moment here. I will show you specifically exactly how to spot every stock market crash before it is happening. Sounds pretty good, right? Type a number 1 in the chat if you want to learn that. Type a number 2 in the chat if you're like, oh, this guy's full of baloney. He doesn't know what he's talking about. This is all kinds of monkey donkey garbage, right? How about this? Let's go to, I don't know, maybe 1929, right? 1929, surely we wouldn't be able to see the largest crash that caused the depression in 1929 before that happened, right? Surely not. Oh, well, let's just see. Let's just see real quick. 1929 dash, let's do October 1st. How's that sound? Let's go to October 1st, 1929. Oh, don't think that worked. Hang on, let's try that again. 1929, 10:01. Oh, there we go. Okay. Let's go there. There it goes. Okay, cool. Check this out. Now, obviously, data record keeping was different back then. But what we can see here is we had this blue line over the black line, and all that's over the red line. Now, let's discuss what these lines are. The blue line is your 10-period moving average. The black line is your 20-period exponential moving average. These are all EMAs, exponential moving average. And the red line is the 50-period exponential moving average. When the 10 is over the 20 and price is over the 50, this is a bullish market condition. So let's take a look at this, right? Let's take a look at this. Tell me how this is doing right here, right? It's clearly in a big, beautiful bullish trend from June 1929 all the way up. Well, then it starts to break down over here. It starts to break down around October of 1929. And then before the huge move down, let's see, how much was that peak to trough? Peak to trough down here, 41%. Feel like it should have been more than that, but 41%. What happened? The 10, the short-term moving average, went under the intermediate-term moving average, and price went under the long-term moving average before all of that big nasty move down. Okay? So over here, it happened about 2 weeks before the big nasty move down. Okay, well, Chris, that's just a one-off fluke. That can't really happen again, right? How about August 2000? Let's go to August of 2000, the dot-com bubble, right? You know what? Everything's different in 2000, right? Let's do August 1st. Everything was different in 2000 than it was in 1929. This couldn't be this. Wait a minute. Wait a minute. What? Hang on just a second here. Wait. So you're telling me that this sell-off here that started here and went down. Come on, clicker. That started here. There we go. Down to here. This 30% sell-off here. And that looks like it even went further on down later. But you're telling me that we actually had advance notice of that? Yes, that's exactly what I'm telling you. Your 10 went under the 20, price went under the 50. Well, what about over here, Chris? 10 was under 20, price was under 50. Yeah, it's true. Not every time it goes under will that mean a crash. But every time there is a crash, it goes under. It starts like this, right? This is your warning sign. This is the canary in the coal mine. This is the red light that you want to see. Exactly what you are looking for to know if it is working or not. Okay. Well, that's just 2 instances. Surely you can't find a third instance in December of 1972. Well, let's just take a look over at December 1972. 1972, 1201. Okay. December 1st, 1972. All right. Wait a minute. You've got your bullish trend right here. And you've got the start of a bearish trend right here. And then it went down in December 1972, January of 1973, all the way down, picked up a little bit again, and then continued on down once again. You can't tell me that this doesn't work. Oh, wow, it went real deep, didn't it? You can't tell me that this doesn't work. The reason that I can say this with unequivocal confidence is because it is math. If your 10 period moving average is below your 20 period, that means the average price over the last 10 days is now lower than the average price of the last 20 days. That means it is trending down in price. And if both of those are below or if price is below your long-term moving average, their 50-day, that means it is going down in price. Does that mean it will continue to go down forever? No. And I'm not claiming it is, and I'm not making predictions. But what I'm telling you is that it must have this happen in order to go down and crash. Let's look another random one. November 1968. November 1968. 1968, 1101. Okay, November 1968. Does it happen again? Yes. Your 10 under 20, price under 50. It pops up a little bit here, and that's part of the game, knowing when to get in and when to get out. And it happened again. And then just a few weeks later, your 10 was over the 20, price was over the 50, and you had a big, beautiful uptrend. It always works. It always works because it's math. It always works because it's math. Now, I don't know if Damien's heard of this, and that's okay if he hasn't. Hopefully now he knows that with 3 moving averages, that'll show you the price direction. You can trade along with that price. Now, does that mean you'll get in at the very top or the very bottom and get out the very top? No, of course not. But you can take 80% of this move, forget about the bottom 10%, forget about the top 10%. You can get the 80% of the move and still make crazy amounts of money. Manny, he's like, you know what? I don't know about this. How about October 19th, 1986? All right. Chris was an itty bitty baby boy at that point. 1986, 10/19. Chris was exactly 7 months old on that date. How about that? How about that 1987 crash? How about that 1987 crash? How about the moving averages crossed over October 7th, 8th, 9th, 10th, or 12th? There's a weekend. 13th, 14th, 15th, 16th, 19th. Tell me it doesn't work. Go ahead. It's math. It is probably what Jim Simons is using, which nobody knows exactly what Jim Simons is using. But I can tell you one thing. This always works because it is only math.
A tiger, but I'm just saying, if these cards were actually good at predicting things, they would know that I needed a tiger and we would have had a tiger there, but yeah. As a species, we often see patterns where there is none. If the past, by bringing us surprises, did not resemble the past previous to it, what I call the past, then why should our future resemble our current past? It's anyone's guess what that means. I think what he's saying is, if people in the past couldn't predict today, then what makes you think people today can predict the future? When the markets are at all-time highs like they are today, and the headlines get gloomy, it can be really tempting to listen to the predictions because they get very loud. But at a point like this, You don't need prophecy, you need a plan. Here's mine. Here's what I do as an investor in times like this. Please understand that this is not investment advice. Don't take investment advice from a guy in his spare bedroom, sat there with
Exactly. Don't listen to random guys on the internet. That is a terrible idea. Don't ever even listen to a random guy on the internet. Not once.
tarot cards. But I'm a global index investor. That means I buy the whole world. And I currently invest with a 20 to 30 year time horizon because of my age, but I'll cover what I'll do when I get a little bit older as well. But because I buy the global stock market, I see this one of two ways. So either the prices go up, which they tend to long term, or they always have in the past. Past performance is no guarantee of future results. But let's say over the next few years, the prices go up. I wish I bought more today. Or the prices go down. That means it's cheaper than it is today. And I'm going to buy into that because I understand that after prices drop.
Okay, so here is where being a trader makes a huge difference in your life, right? So I want to go to a stock. You've probably heard of it. It's called HIMS. HIMS is a trader's dream because it is so, I wouldn't call it predictable. What I would call it is tradable because it shows you when it's moving up, and then it shows you where to get out and when it's moving down. And then it shows you when it's moving up, and it shows you where to get out and when it's moving down. And then it shows you when it's moving up, and it shows you where to get out when it's moving down. And then it shows you when it's moving up. And let me remove all the notes on here real quick. And then it shows you when it's moving down. This is a ultra tradable stock. And unlike what he's talking about here, buy while it's cheap, right? It's not buying just for the sake of buying. It's buying because you've got these moving averages crossing over, right? So you can buy it when it's cheap, right? $32 when it goes up to $64, right? A doubling right there. But he doesn't know when this is going to go back up. Okay, let's look at the S&P 500 from. Let's zoom out a little bit on the weekly chart here. Let's go back to the 2000s. Okay, so in 2000, let's say August of 2000, September of 2000, the S&P 500 peaked. And then it went down, bottomed around 2003, came back up by 2007. So if you were buying it on the way down over here, you would have been years before you got back to break even. So let's use this as an example. Let's say you're like, oh, you know what? The market's gone down, so therefore it's cheap. I need to buy some. And that was at 132. Oh, the market's gone down more, so it's cheap. I need to buy some more at 116. Oh, it's gone down more. I need to buy some more at 103. Versus, oh, look, the market has shifted. The 10 is now over the 20. Price is now over the 50. I'm going to get in here. Now, this is on the weekly chart, and it works on all time frames. All time frames. Okay, well, if I got in at 103 and you got in at 103, I'm to profit immediately. You took from July to October. So it took you 3-4 months, November, to get back to break even. Yet we have the same average price over here. Rather than buying it all the way down in August of 2001, I decided I was going to buy it on the way up in November of 2004. So I am to profit that much faster. You had to wait 3 years for this to happen. Right? Buy stocks as they're crashing up, not as they're crashing down, because we don't know how far down it's going to go. We have no idea how far down it's going to go. But we can see when the tide has changed and it's going back up. So this idea of buying while it's cheap sounds great, but in reality, you don't know where cheap is, because I can tell you the people who bought it at 150, when it got down to 133, they're like, man, this is cheap. I got to buy some more. When it got down to 116, man, this is cheap. I need to buy some more. When it got down to 103, man, this is cheap. I should buy some more. Pretty crazy, but math is always mathing around here.
In the stock market, the expected return increases long term because I'm getting more units of the same thing for a cheaper price. It's on sale, essentially.
Oh, barf. I don't want to watch any more of this. I have to rage quit at this point. No. Here's the thing. And I would really love to talk to Damien about this. I'm buying more at the same price because it's on sale. No, dude. No, dude. You got to wait for it to come back up. Because if you bought here, here, and here, your average price will be exactly the same. If you bought 100 shares here, here, or here, as it would be if you bought 100 shares here, here, or here. The difference is that I didn't have to worry. I didn't have to wait to be at break even. I didn't have to barf. But my average price would be identical to the penny if I bought it on this side or on this side. Same thing over here. If I bought it here, here, or here, I would have the exact same price as here, here, or here. And I would be to profit that much faster. So I don't want to watch any more of this. And here's the deal. You can see the direction of the market. It's not saying that you're predicting. And in fact, I would encourage you to never set a prediction, right? Anybody who's going out there saying, my price target on Palantir is $500 a share. My price target on AMD is $1,000 a share. They're stupid. They don't know what they're talking about. They're literally stupid. They clearly do not understand how the game works, right? Because in reality, they could never, ever, ever hit that price, ever. Even if the analyst is JP Morgan's like, right-hand man, not Jamie Dimon's, but actually JP Morgan's right-hand man. And he says, I think that Google is going to be $4,000 a share. Doesn't matter. If he says it or if you say it, it doesn't matter. The only thing that matters is what direction the price is going. And if the price is going up, you can make all kinds of money without making predictions. If the price is going down, you can get out of the way and let it go down as far as it can without making predictions. All you got to do is have a plan and follow that plan and not set any expectations on what the outcome will be. Yes, you're going to have losers. Get over it. You're never going to have a 100% win rate. Get over it. But you don't need a 100% win rate to create generational wealth. I want to help you with that. I want to help you save time, make money, and start winning with less risk. But you got to click one of these two videos for me to help you out. And you got to have a fantastic day. We'll talk soon.